Across America, the housing market is shifting again. And this time, it's the landlords who are panicking. After years of rising rents and bidding wars, the tide has turned. New apartments are sitting empty. For rent signs stretch across entire blocks. And investors who once believed housing was a guaranteed goldmine are watching their profits evaporate. According to recent data, the U.S. multifamily vacancy rate rose to about 7% in Q2 2025. Builders over-delivered during the pandemic-era boom, expecting endless demand. But now migration has slowed, affordability has peaked, and renters are pulling back. The result is clear: skyrocketing vacancies, slumping rents, and a reckoning for landlords who borrowed big when the market was hot. Today on EstateScope, we're revealing the top 10 U.S. cities where vacancies are skyrocketing right now, and exploring how overbuilding, outmigration, and inflation have combined to create the most dramatic rental downturn in a decade. Welcome to EstateScope, the channel where we expose the hidden forces shaping today's real estate markets. From climate risk to insurance pullouts to overlooked government policies, we break down what's really behind the headlines and what it means for your investments, your home, and your future. If you're into real estate with a twist of investigative reporting, hit like, tap subscribe, and ring the bell icon so you never miss a story that could impact where you live, what you buy, or how you build. Now, let's get into what might be one of the most overlooked real estate catastrophes of the decade. Number 10. Phoenix, Arizona. On the surface, Phoenix embodied the Sunbelt boom. Wide open skies, affordable homes, and a booming job market that pulled in families and remote workers from across the country. From 2020 to 2022, it ranked among America's fastest-growing metros, as noted by U.S. Census migration data and CoStar growth reports. Apartments filled before construction finished, and landlords doubled rents without hesitation. But in 2025, that dream is cracking. According to Matthews Real Estate Investment Services, multifamily vacancy in Phoenix jumped to 11.9% in Q2 2025, one of the steepest in the Southwest. At the same time, MMG Real Estate Advisors found average asking rents dropped about 2.8% year over year, signaling real softness even as new supply hit the market. Meanwhile, the construction pipeline remains oversized. Roughly 23,000 units still under construction across Maricopa County, according to Matthews and CoStar's Q2 data. Construction never truly slowed. Even as leasing demand faltered, developers pressed forward on projects started during the pandemic-era boom. Beyond overbuilding, climate fatigue and affordability pressures are adding strain. Record-breaking 115-degree summers, escalating water restrictions, and rising insurance costs have made retention harder for landlords and living costs higher for renters. Across the metro, you'll now see it everywhere. 2 months free. No deposit required. Banners stretching down major arterials like Camelback and Tempe Town Lake. Landlords are fighting to stay afloat. This isn't just an oversupply story. It's the clash between ambition and sustainability. A city that soared too quickly, ignoring the natural limits beneath it. For developers, it's a painful reckoning. For renters, long overdue relief. And for the nation, Phoenix is an early glimpse of what happens when population growth, construction, and climate stress collide. Number 9. Austin, Texas. For nearly a decade, Austin was unstoppable. A city of music, tech, and optimism, where startups and sound stages blurred together under a skyline of glass towers. Between 2015 and 2022, Austin ranked among the top 3 metros nationwide for in-migration, driven by the promise of no state income tax, vibrant culture, and booming remote work opportunities. Californians, New Yorkers, and digital nomads poured in, calling it the next Silicon Valley of the South. Apartments filled faster than developers could build them, and rents climbed to record highs. But in 2025, that story has reversed. According to Matthews Real Estate Investment Services, Austin's multifamily vacancy rate hit 15.1% in Q2 2025, the highest among major U.S. metros tracked that quarter. At the same time, average rents fell 4.3% year-over-year, the steepest decline in over a decade. That collapse wasn't random. It followed a perfect storm. Developers, confident in endless demand, delivered more than 6,500 new units in the first half of 2025 alone, a figure confirmed by CoStar's June 2025 supply report. Just as net absorption turned negative for the first time since 2011, entire luxury high-rises now sit half-lit at night. Leasing agents are offering 3 months free, waived deposits, and even gift cards just to fill floors. Once coveted neighborhoods like the Domain, East Riverside, and downtown Austin are saturated with new inventory, much of it high-end, while renters are trading down or leaving the metro entirely for cheaper suburbs like Pflugerville or Kyle. The underlying driver? The tech slowdown. Layoffs at companies like Tesla, Indeed, and Meta's Austin division cut deep into the renter base, while the influx of remote workers, the very trend that supercharged Austin's growth, has now reversed. More employees are being called back to coastal headquarters, shrinking demand for the upscale downtown apartments built during the pandemic. Meanwhile, the cost of living, once Austin's main draw, has quietly eroded its advantage. Property taxes have climbed more than 20% since 2021, and utility rates are rising with energy demand. Insurance premiums are surging as climate risk grows. According to the Austin Board of Realtors' 2025 Outlook, Austin's affordability gap has widened faster than any other major Texas metro. What we're seeing now is the hangover after a decade-long party. Developers and investors believed the migration boom would never stop. But when the music faded and the tech money thinned, Austin was left with too much supply chasing too few tenants. Today, the market reflects that overconfidence. High vacancies, falling rents, and rising concessions. The cranes that once symbolized opportunity now stand as reminders of imbalance. Austin's rise was built on optimism. But 2025 is teaching the city a harsh lesson. Even America's brightest boomtowns can overheat. And when that happens, equilibrium returns, whether landlords are ready or not. Number 8. Atlanta, Georgia. Atlanta once symbolized the South's promise, a city of cranes, construction, and confidence. From 2018 through 2023, it was one of the fastest-growing metros in the U.S., adding more than 400,000 residents according to the U.S. Census Bureau's 2024 population estimates. Tech companies, film studios, and logistics firms turned Midtown and Buckhead into cranescapes of glass and steel. For years, the growth felt unstoppable. But in 2025, that story has changed. The city's multifamily market, once the crown jewel of the Southeast, is under strain. According to Yardi Matrix's September 2025 Southeast Multifamily Report, Atlanta's occupancy rate slipped to 93.1%, translating to roughly 6.9% vacancy, the highest since 2014. That decline might sound small, but in a metro with over 400,000 rental units, it represents tens of thousands of empty apartments. At the same time, rents have stopped climbing. Zillow's August 2025 Housing Index shows Atlanta's median asking rent down 0.8% year-over-year, breaking a 7-year streak of gains. So what's driving this reversal? It's a combination of wage stagnation, overbuilding, and the Airbnb unwind. For years, developers assumed migration from Florida and the Midwest would continue indefinitely, and built accordingly. According to Cushman & Wakefield's Q2 2025 Atlanta Market Report, over 14,000 new apartments were delivered in just 12 months, with another 16,000 under construction, a record pipeline. But population growth has slowed dramatically since 2023. The influx of remote workers has cooled, and short-term rental hosts are now converting units back to long-term leases to keep cash flow steady. That sudden flood of new listings pushed supply far beyond what renters could absorb. The result? Incentives everywhere. In Midtown, once the epicenter of high-demand luxury, leasing offices now dangle 2 months free or no deposit, no application fee signs on nearly every block. In East Atlanta and Old Fourth Ward, boutique landlords are offering flexible 6-month leases, unheard of during the boom years. Even small investors, those who bought duplexes or small apartment complexes during the pandemic frenzy, are feeling the squeeze. As property taxes and insurance premiums continue to rise, many are discovering that their once cash-flowing rentals no longer pencil out. The imbalance isn't just financial, it's psychological. Atlanta's housing optimism was built on the belief that growth was infinite, that the city's charm and affordability would always draw people in. But in 2025, inflation is squeezing renters. Wage growth has flattened, and the cost of living, from groceries to gas, has caught up to the national average. Even Moody's Analytics warns that Atlanta's rental growth trajectory has plateaued as affordability pressures limit absorption. So now, the cranes that once symbolized prosperity also tell a different story, one of oversupply meeting economic fatigue. Atlanta's housing market isn't collapsing, it's correcting. It's the South's reality check. A reminder that even booming metros can outbuild demand when optimism outruns fundamentals. And for developers and investors who banked on endless growth, 2025 is proving one thing loud and clear. In real estate, even in the South's brightest city, gravity always returns. Number 7. Tampa, Florida. Tampa was once one of America's hottest real estate success stories, a shining emblem of the Sunbelt boom. Between 2020 and 2023, billions in investment poured into the Bay Area. Cranes filled the skyline. High-rises along the Hillsborough River and Water Street promised a modern, walkable paradise. The story was simple: sunshine, space, and steady migration meant endless demand. But in 2025, that confidence has cracked. According to Yardi Matrix's Q2 2025 multifamily report, Tampa's vacancy rate has risen to roughly 7.3%, up nearly 2 full points from last year. Rents, meanwhile, are down about 6% year over year, marking the steepest drop in the Southeast. On paper, that might not sound catastrophic. But for a metro that once posted double-digit rent growth every year, it's a clear reversal of fortune. The problem isn't just cyclical, it's structural. Developers built for the top of the market. Glossy, high-end apartments aimed at affluent newcomers from the Northeast and Midwest. But demand for that luxury tier has thinned. The pandemic migration boom has cooled, and those same newcomers are now hesitating, squeezed by high insurance premiums and record property taxes. According to the Florida Office of Insurance Regulation, property insurance costs in the Tampa Bay region have tripled since 2019, making it one of the most expensive insurance markets in the country. At the same time, the threat of hurricanes has sharpened investor anxiety. Hurricane Milton's near miss in late 2024 drove reinsurers to raise rates across the Gulf Coast, and many landlords saw coverage premiums jump 20 to 30% overnight. The result? Landlords are passing those costs to renters. But renters have hit their limit. Tampa's average household income has grown only 3% since 2022, while the cost of living has surged nearly 10%. According to the Bureau of Economic Analysis and Zillow's Affordability Index. For middle-class renters, the math doesn't work anymore. Families that once flocked to Hillsborough County for affordability are now heading north to Pasco, Polk, and Hernando counties, where rents are hundreds cheaper and insurance burdens lighter. The exodus is visible in the details: half-empty parking garages, quiet downtown lobbies, rooftop pools shimmering in silence instead of laughter. Leasing banners stretch across luxury towers that once had waiting lists. Developers, too, are feeling the sting. According to CoStar's 2025 pipeline data, more than 9,000 new units remain under construction across the metro. But absorption has flatlined. Investors are now delaying projects or quietly selling mid-build developments at a loss. Tampa's landlords are discovering a painful truth. When your market depends too heavily on migration, the slowdown hits twice as hard. Demand fades, and then revenue collapses. The city isn't collapsing, but it's correcting. What was once an unstoppable boom is now a cautionary tale about the limits of optimism and the high cost of building too much, too fast, for too few who can afford it. Tampa's skyline still glistens under the Florida sun. But behind those reflections lies the quiet reckoning of a city, learning that growth without balance can't last forever. Number 6. Las Vegas, Nevada. Few cities reinvent like Las Vegas. After the pandemic, it wasn't just the Strip that roared back, the entire valley exploded. From 2020 to 2022, Las Vegas ranked among America's fastest-growing housing markets. Californians rushed in, investors piled on, and developers raced to build luxury towers across Summerlin and Henderson. But in 2025, the roulette wheel has stopped spinning. Reported vacancy is around 9.5% in Q3. Rents have fallen approximately 7% year-over-year in some segments. Development still hit the skyline, but many of the projects built now sit half-empty. Developers bet on endless tourism and migration. Both have cooled. The service worker base that makes the city run is relocating to cheaper suburbs or states. Each departure leaves another empty unit behind, fueling a dangerous cycle of oversupply and declining demand. Away from the neon lights, the signs of stress are everywhere. Las Vegas still glitters, but the shimmer hides the strain. Number 5. Dallas-Fort Worth, Texas. Dallas once felt invincible. Corporate relocations, sprawling suburbs, and endless cranes defined the skyline. Between 2020 and 2024, the Dallas-Fort Worth metro added over 105,000 new apartments, according to CoStar's Multifamily Construction Index, more than any other metro in the United States during that period. Developers called it progress. Economists called it unstoppable. But in 2025, the limits became clear. According to Yardi Matrix's Q2 2025 market report, vacancy rates across DFW climbed to roughly 11.4%, the highest since the Great Recession. The red-hot rental market that once symbolized Texas's economic boom now feels eerily quiet. Entire master-planned communities in Plano, Frisco, and Uptown are offering unprecedented deals. 3 months free rent, waived deposits, even discounted parking just to stay competitive. Some luxury developments have slashed rents by as much as 8% year-over-year, the steepest decline in over a decade. What happened? The issue isn't just overbuilding. It's that the migration wave that fueled the boom has finally crested. For years, DFW benefited from a steady influx of residents from California, Illinois, and New York, lured by lower taxes, job opportunities, and wide-open space. But according to the Dallas Federal Reserve's 2025 Regional Migration Update, net migration into North Texas has dropped 27% since its 2021 peak. Corporate relocations, once the bedrock of DFW's housing surge, have also cooled. Goldman Sachs delayed its Dallas campus expansion. Caterpillar froze hiring. Tech layoffs and slower logistics growth have softened the job market. Developers who borrowed aggressively during the zero-rate era are now facing higher interest payments on properties leasing at half capacity. In short, the math no longer works. Many landlords are holding units vacant rather than slashing rents, hoping for a turnaround that hasn't arrived. Others are quietly offloading assets, some at losses of 10 to 15%, according to CBRE's Q2 2025 Texas Multifamily Report, just to avoid negative cash flow. Meanwhile, new supply keeps coming. Another 38,000 units are still under construction, much of it in Collin and Denton counties, where cranes dominate the horizon. But absorption has slowed to a crawl. For renters, it's a welcome shift. The bidding wars are gone. Choice has returned. Incentives are everywhere. For landlords and investors, though, 2025 marks a sobering reckoning, the moment when easy money met economic gravity. From a distance, Dallas still shines. The skyline glittering, highways packed, optimism intact. But look closer, and the fatigue shows. Empty units, quiet leasing offices, and developers caught between hope and reality. The cranes that once symbolized endless growth now stand as monuments to overconfidence. Dallas's rise was built on ambition, its slowdown on lessons. And as Texas learns to balance expansion with sustainability, one truth becomes clear. Even the fastest growing markets eventually hit the wall. Number 4. Denver, Colorado. For years, Denver was the dream city. The Rockies as a backdrop, sunshine, and startups fueling explosive growth. Between 2020 and 2023, rents surged nearly 30% as newcomers poured in from California and Texas. Developers rushed to keep up, flooding the skyline with high-rises. But in 2025, that boom has cooled. Vacancy rates hover around 9.3%, and rents are down roughly 8% year-over-year, the sharpest drop in over a decade. Many luxury buildings that once had waiting lists now sit 30% empty. The problem? Developers built for the wealthy while middle-income renters left. Hybrid work reversals and high inflation are driving people to smaller, cheaper towns nearby. From afar, Denver's skyline still gleams, but behind the glass, entire floors sit dark. Number 3. Miami, Florida. Miami once seemed unstoppable. Luxury towers, global investors, and remote workers calling it paradise. Between 2020 and 2022, rents soared nearly 60%, and condos sold out before completion. Now, the glow is fading. In 2025, vacancy in South Florida hit 8.9%, with rents down 10 to 15% citywide. Insurance premiums have tripled, property taxes are surging, and hurricane risk keeps rising. Developers built for the ultra-wealthy, but the ultra-wealthy stopped buying. International investors pulled back, and locals are heading north to Orlando and Jacksonville for affordability. Miami's brand of luxury has become its burden, a market priced beyond sustainability. Number 2. Seattle, Washington. For decades, Seattle was untouchable. A fortress powered by Amazon, Microsoft, and endless tech jobs. Apartments leased within hours. Rents never fell. But by 2025, cracks are showing. Vacancy rates reached 9.5%, and rents are down nearly 9% year-over-year. CoStar, 2025. Tech layoffs and a slowdown in hiring have drained demand, while remote work keeps many workers away from downtown. Developers caught mid-project are slashing prices and offering months of free rent. Seattle's not crashing. It's correcting. A housing market once defined by tech-fueled growth is now learning what happens when expansion outpaces stability. Number 1. San Francisco, California. At number 1 stands the city that once defined urban success. For decades, San Francisco was the gold standard of real estate. Demand never fell, prices never softened, and scarcity fueled endless appreciation. But in 2025, that myth is gone. Vacancy rates soared to over 11%, the highest in the nation. Rent reductions of 15 to 20% are now routine. Landlords are offering months free rent, no deposits, move-in bonuses. and units still remain empty. The reasons are staggering. Remote work hollowed out the city's core. Downtown offices stand dark. Tech layoffs drained the renter base. Property taxes and insurance hikes bite hard. Public safety concerns mount. Neighborhoods like Soma, Mission Bay, and parts of Nob Hill, once the heartbeat of urban affluence, are now dotted with now leasing banners. Occupancy in some new high-rises has dropped below 80%. Unthinkable just a few years ago. The fallout extends beyond housing. The local economy is unraveling. Restaurants, dry cleaners, coffee shops, all the small businesses that depend on renters and workers are closing in record numbers. San Francisco's collapse is not just financial, it's symbolic. It marks the end of an era where cities believed tech wealth could defy economic gravity. The Bay Area's beauty remains undeniable. The bridges, the fog, the hills. But behind that postcard lies the epicenter of America's landlord reckoning. The city that once seemed invincible is now the warning. No market, no matter how rich or iconic, is too big to fail. From Phoenix to San Francisco, America's rental landscape is undergoing a transformation. For years, landlords held the power, raising rents, demanding premiums, watching demand soar. But in 2025, that power is slipping away. Vacancies are rising, tenants are bargaining, and overbuilt cities are being forced to confront what happens when profit overtakes sustainability. Some see this as a crisis. Others as a reset, a chance to rebalance housing, affordability, and community. Whatever the outcome, the message is clear. The era of unchecked rental growth is over. The new era belongs to balance and to those who learn from the crash. Stay alert. Stay informed.
Thanks for watching. If you found this helpful, please like, comment, and share to help others stay informed. And don't forget to visit EstateScope on YouTube for the full video and more real estate insights.